let's start. What we have been doing was we were discussing about financial statement and ratio. We started last week, so I'll quickly go through what we have done on financial statements and analysis. Basically, so we discussed about importance of financial statements and like key terminologies like what is performance, what is position, and then we discuss about types of financial statements. So I told you that these four are very important for exams, so you need to know by just to list these, and you need to know just to brief with the one or two sentences, and then give a kind of a brief description on each item. And then we discussed the tools of analyzing the financial statements. One is like across time, we call this horizontal. The one is like comparison within the industry, that's we call trend analysis or industry analysis. Then within the financial statement, that is called the vertical analysis. The final one is the ratio analysis that we have gone into detail. So for computation purposes, we have done the common size income statement, and for the balance sheet and P&L using that. So we have discussed various financial ratios. That is mainly there are six actually. So we go into detail about at least five, because we have not discussed the market performance in detail because the lack of information. This slides basically gives us the importance of financial ratio, why financial ratio, who are the like beneficiaries, kind of like today we will continue some of these aspects as a winding up of this presentation or the section while looking into the financial ratios importance and their usage further. So these are the categories: liquidity, efficiency, leverage, coverage, profitability, and market valuation. Except market valuation, we have gone into detail with the illustrated example, so that I think you are very much familiar on these. So whether it's come to the MCQ or in the section B, so you are not in like a difficulty to attempt these questions, right? So having said that, so we'll straight away switch to the way we stopped. That is yeah, up to I think we have come to this level. So this is very important again area where sometimes that we have been asked to compute, especially in MCQ or section B questions. So we may have been asked to compute financial ratios. So when we are being asked to compute financial ratios, so what we could do is, so we can make use of these four rules for memorizing the ratio, so that it would be very easy for us to you know uh, give a kind of the correct answer, right? So there are three basically ratios, the rules that we can make use of for memorizing purposes. First one, any margin ratio is something divided by sales. So let's say if you have forgotten one of the ratios, and but if the particular ratio comes with the margin like NP margin, OP margin, GP margin, like that means, so GP divided by sales, that's what say. Margin ratio is something divided by sales, like GP divided by sales, NP divided by sales, OP divided by sales. So it is very very like easy for us to memorize it in case if you have not you know the particular ratio in your mind at the time of computation, right? Then any turnover ratio is sales or variation of sales divided by something, like stock turnover ratio, maybe debtors turnover ratio, creditors turnover ratio, maybe fixed assets, net assets turnover ratio. So whatever we say, then what is it's basically sales or variation of sales. It could be sales or it could be cost of sales, like that. Now example, if you say debtors turnover ratio, that is debtors divided by sales. If it is like stock turnover ratio, stock divided by cost of sales. It's a fixed asset turnover ratio is basically fixed assets divided by uh, basically sales of variation of sales divided by something means sales divided by fixed assets. Earlier two has to also be to change, like if debtors turnover ratio, sales divided by debtors. Cost of sales, stock turnover ratio means cost of sales divided by stocks. So that's basically when it comes to turnover, you know what exactly we need to look into, whether it's a sales or variations of sales, right? So then it's very rare that we missed it because we have everything here. Like when you say stock turnover, obviously the stock should be there. The other parameter could be sales or whatever variations of sales. That's the second rule. The third rule is the return on, right? Return on ratio is net income or variations of net income divided by something like return on assets, return on investment, return on equity, right? So whenever it comes like return on equity is something basically net income divided by something. So that is return on equity, obviously net income divided by equity. Return on investment, total investment divided by net income divided by total investment. So return on assets, net income divided by total assets, like that. So means there are three rules that we have been provided in order us to understand some of the ratios in computation. So ideally, it's good that you memorize it. But in case if you have not memorized or if you are have forgotten during the examination, so you can use these three ratios to some extent to come up and calculate the ratios. Hope you have got an idea. So any difficulty? Any question? Okay, let's move on. This is again important in case of exam. So sometimes he might, or the examiner could ask, maybe the purpose, importance, usage, right? So some features of ratios like that. So when general question comes, you can use these things in order to give a better answer. As we discussed on the other day, so ratio calculation is, pointless unless you know how to use them. So that's obvious, right? So whatever you're going to do, so there may not be a kind of an, the advantage for us to, if you are not knowing what exactly the purpose of these ratios. Hence that, you need to understand what are the purpose, advantages, or uses of these ratios. The another point is single ratio provides very little information and may be misleading. So like the last day also we discussed, when you say sales about 5 billion sales is not exactly what we are interested in, or maybe sales growth of 5% from last year to this year may not be very much worthwhile if you don't know what about the industry growth, right? So what about your the comparison against your budget, like that. So always you need to have something like relatively you need to analyze the ratios, so then only you have a better understanding and better value in financial ratio application. So there are four uses of ratios that one can understand. What are those four uses? First one, trend analysis. Second one, comparison to industry averages. Third one, setting and evaluating company goals. Fourth one, restrictive debt covenants. So we'll go now one by one and try to understand what are those, the usefulness, what are those advantages. Okay. When you say trend analysis, internal and external, so what is that? So let's see. It's like this. It involves the examination of ratios over time, right? The analyst tries to determine if the ratio is changing in a favorable or unfavorable direction. The chart shows EPI's current ratio for 2 years. We really need more data. Basically, if you see this current ratio trend, right now in y-axis it says how many times 2.3, 2.3, like that times. So then this comes to year on year. Let's say if you have 96, 97, 98, like that, so throughout say 5-year period, then you can see a trend of movement of the current ratio or quick ratio, cash ratio, efficiency ratios, like that. Then the first idea is we try to find out any trend. Let's say it's like, if the trend is like increasing, and then we can go back and the root cause for this, why the current ratio is increasing, because we have increased the sales turnover and all that, or whether we have taken a decision as a company to have more stocks uh, in our stores, right? So there may be changes in the data policy, so like that. Then you can think about and examine what like the reason for this. So in order to understand that, so better you have some trend plotted in a kind of a graph like that, right? Here, basically when you say trend analysis, we try to understand the behavior of the ratio during a particular period. So not like 2 years. It's good that if you have 3, 4, 5 like that, so then you have a better understanding of the movement of the particular ratio. Okay, but here basically for the understanding they have given for the 2-year data, but obviously it mentions the 2 year is not a very good period for us to comment or come to a conclusion. Okay. This is very important. This is about compare with the industry, because when you say industry comparison, it is very important for us, because now in general, when you say industry, it depends on the particular industry's norms, depends on particular industry's behaviors, right? Maybe current ratio, generally we can say 1.5 and above, quick ratio 1 times and above, it's good. But when you are comparing within the industry, but there you can find the current ratio is not like always 1.5. It may be 2 and above, because the average is 2. So when industry average is 2, and so you are telling my company's current ratio is 1.6, it's not a very good performance. You understand? But though it's above 1.5, we can't say we are good, because the industry is doing that 2 or something. So that's why we need to know what exactly happening in the industry, and based on that, so you can understand, or you can do a sort of industry comparison. So that's why the industry comparison is very important, right? So what exactly we are trying to understand here is we're trying to understand how far or how near with the industry average, right? May not give an exact interpretation, but it gives you a better understanding of the particular company's performance in context of other companies in a given industry. That is the whole purpose of comparing and contrasting industry averages. But good to have industry averages numbers with us, right? So if we can find out the industry stats in a given scenario, it is good for us to understand for your comparison purpose. So that's basically number 2 advantage or the uses of the ratios. Then we move to the number 3, company goals and debt cover. 3 and 4 basically. That is, sometimes the company is going to use this for internal measurement, internal performance measurement. Let's say maybe sales growth, maybe cost to income ratio, or maybe some other like ratio that maybe performance ratios, like efficiency ratios. It could be useful to measure the company, performance within the company, among the departments, among the staff, right, among the management, like basically in order to assess the management, their key performance indicators, their goals. So you can use these ratios, like maybe ROE of a company or ROI of a company, and maybe in a banking sector, very good example for the outsiders like shareholders, investors, to get an idea about company performance. So based on that, so they might come and tell, they might invest, so they are happy about the company performance because you are recording a good ROE. Now, as we discussed the last time, if I remember correct, this time we see total banking sector's ROE has increased around 14 to 15% compared 11, 12, maybe 2 years back. So means that investors think, yes, if we put something in the banking sector, so our return should be now minimum of 14 to 15%. Very good rate compared to interest rates and all that. It's a very good investment if we are investing in banking stocks. That's what they feel like. You understand? So then the company goals, right? It could be a very important. So we can use the ratios to assess the company goals and performance among or within the company and among employees. The last one, imposing debt covenants. So sometimes depending on your credit, so you may have imposed debt covenants in a given financial, using some financial status, like maybe current ratio not more than 2 times, debt to equity ratio should not exceed this one, dividend yield or should be dividend cover should be maintained in these levels. So maybe cost to income ratio to manage at this level. So like that, so you can impose debt covenants whenever you are approving a credit. So that can be monitored over post disbursement period, where you are maybe quarterly or biannually, yearly, so you are monitoring these information, and based on that you are in a position to track the company performance. So that's what basically we talk about, the imposing of debt governance, the importance of the uh, ratios in that scenario as well. So basically we have just discussed 4 important uses of ratios. Now, because now generally the examiner could ask a question from us like, what are the advantages? What are the usefulness? Why that you think the ratios are important in terms of a company performance, like that? There may be general question, or maybe he can exactly ask about what are the advantages of ratios for a company. So you can write a short note, 1, 2, 3, 4. You can list it and briefly describe. Right. So this sums actually with this that so we are in a position to complete uh, the financial statement ratio and analysis. Any questions from your end? Any questions before moving to the next area? Okay, fine. So then now let's move to the, I think with that, I think it's almost over. This is basically kind of a summary. That's a 1, 2, 2, 3 line. So, right. Right. Now we are moving to a new area, new session, right? This is about investment tools in project financing. So far that we have been, doing different subject areas, right? So that maybe talks about um, supporting tools in terms of evaluating a project, right? So we discuss about working capital, we discuss about break-even analysis, then we discussed financial ratio statements, and then non-financial tools, right? So we have covered many areas which we think that is important in terms of understanding, analyzing the project appraisal, project cycle. So this one is also very important in terms of project appraisal. So what is this? Investment tools and investment analysis. Before starting the going to the learning objectives, let's understand what is investment decision and what is financing decision. So let's say you are a sponsor, promoter, and investor. So you have some money with you, right? And then if you want to take a investment decision, to think about, let's say you want to do some project. So you think whether I am going ahead with or not. Say you have for the time when you have say 50 million in your custody, in your hand, then you come and see whether you go for a 3-star or 2-star restaurant, hotel in some area, or you acquire maybe a ice factory in a fishery area and start that operation. Or you can think about purchasing a tea factory, or maybe tea bare land, and then you think about analysis about to conduct a tea manufacturing business. So like that, so you might have a first analyzing what type of investment that you are going to do, whether to do or not. For that, yes, you need to do some kind of analysis. That's one. Suppose you decided to go one of these projects, then you think about the financing decision. How should I do? Right? Whether I use my own funds, whether I go for a joint venture, whether I do like bank loan, whether I go for a initial public offering. So that is about financing decision. So there are two things that we need to understand: investment decision, financing decision, right? Me very close example, family example. Let's say if you want to purchase a vehicle. So first you need to think about whether I am going to buy a vehicle or not. So whether I need a vehicle or not is your investment decision. So whether still I use the public transport, whether still I use the office transport, right? Whether I going with a friend like right now I am doing. So these are kind of some options available with you. But suppose that you wanted to, no, I should go for a vehicle. It's an investment decision. Maybe at a personal capacity I'm talking about. And then the financing decision could be, how should I execute my investment decision? Whether to outright purchase, whether to go for a loan, whether to go for a finance lease, whether to go for a operating lease, or whether to go for a hire. So like that, then it's like financing decision. So based on that, what I'm going to do is the financing proposition. Hope you understand. So there are two major decisions the investor promoter in terms of project financing need to take. That is investment decision and financing decision. So if you are going to investment decision, this session is important. just to understand what is all about this nature and the importance of this investment. Then what are the tools available for us to ascertain the feasibility, the viability of this investment, whether to go ahead or not. That's all about this session is. And examination weightage also is very high, where almost every paper we have some kind of a question being posed under this section. Okay, if you do have any questions, yes, you can raise it and ask while we understand its concept. So learning objectives basically understand the nature and importance of investment decision making in an organization. Nature, importance of investment decisions. Why these investment decisions are important for us, and what are the features of these investment decisions in case of organizations on day-to-day activities. Then we try to understand what is this project infrastructure financing, project financing. So that's again, it's important for a project appraisal also, but here we try to understand what is this project financing, investment financing, infrastructure financing. Then we try to understand what is time value of money and the discounting factors. These are something which are new for us to understand, and it is important in terms of project financing and project appraisal. Then what are the 4 investment appraisal methods? What are the 4 investment appraisal methods, and how to evaluate investment proposals using those? There may be so many, but we try to understand there are 3 or 4 methods available, and what are those? And using those methods, we try to understand illustrated examples for more internalizing. Then advantages and disadvantages of each tool, each method, that is important, especially for exams, if they ask about compare, contrast given investment methods. Then based on our analysis, how we are going to recommend what is good, what is not good, what is our choice, and what should we leave out. So like that, those also been given us, those also can give us an understanding. We move to nature and importance. What is this nature and importance? Especially this project financing, what is nature, right? It's long term rather than a short term. Now we talk about investments here, right? Investor come in and investing money in a project means it is for long term, not for short term. Like you purchasing something for day-to-day working capital, and maybe bulk stock and dispose it with the profit. It's a short-term decision. But if you are putting up your money to purchase a factory and make kind of some production, it's a long-term decision. So the time horizon is like basically long to short in terms of nature. That's one. Number 2, large investment versus the small investment. Large investment versus the small investment. Because now, if you take about a project, the value that you are talking about is huge, not a small. Maybe it's a 5, 10, 15, 20 million is investment that you can plan out for about 2 to 3, 4 year repayment. But 100, 200, 300 million investment is you can't recover in very limited period. So it could well go beyond 7, 8, 10 years. So basically, that's the difference between large investment versus the smaller investment. Then more complicated from future cash flows and the time value of money. Now, when you say it's a long-term recovery, large investment, people tend to think about different assessment tools, measurement tools, evaluation tools on your investment. two things are future cash flows and the time value. A future cash flows is basically, let's say if you invest 100 million on a tea factory and tea state, you can't recover the money a following day or following year. It takes some years, right, to get back your investment covered. Maybe let's say break even. Initial investment to cover, maybe it takes maybe 7 to 8 years. So then you also making some profit in the meantime, but it tells you it's long term and it depends on future cash flows. How well under your management the tea factory and the tea estate would do. Whether you can generate cash, whether you can get the tea leaves from the smallholders at timely, you can negotiate with your brokers, get a good price, the quality that you can maintain within the factory with the good staff and machinery in place, right? So those are some of the things that you need to be worried. Then time value of money also important. Later we will understand very much in detail, where in nutshell, in brief, it's a value of the money is going to be changed over time. Maybe having 100 rupees today, you can do X number of activities, but after 1 year, having the same 100, you cannot do the same number of activities in terms of, I think, meeting cost. Why? Maybe cost has been increased. Right? 100 rupees that you can purchase, say, these fruits, for example, go to supermarket. When we go to after 1 year, obviously you don't have that capacity. Maybe your purchasing power has come down. Basically, it's the time value of money. Over a period, the value of the money could come down. So hence, it's also important in terms of understanding the nature features of the investment. First one, long-term, short-term, larger versus smaller, complication in terms of future cash flows, complication in terms of time value of money. There are 4 features that one can understand about project financing, investment financing, in the investment of entrepreneurs, infrastructure financing, right, or term financing. So you can name it in differently, but nature features are, different one to another. One. Then we need to understand importance for the investors in these concepts, right? Large amount of resources are often involved, right? Here, maybe in terms of staff, maybe in terms of effort, maybe in terms of money, right? Maybe in terms of, the activities, there may be a bigger involvement of these resources, right? And then that itself tells you about company profitability may depend on this investment. So either if you are not succeeding in this investment, your survival as a company could be questionable, right? So the profitability, survival, business strategy are very important aspects that we need to be mindful of. That's the importance that we are talking here. Then difficult to bail out once an investment made. What it mentioned. It is like this. Let's say now we are going to put up a tea factory and the tea estate. Rather than just go and purchase, so you might have undertaken some research activities. You have given the kind of, the sort of initial feasibility study to one of reputed professionals. So you need to pay for them. There may be some initial work that you need to undertake in order to succeed the pilot project. So based on that, so you might think about, yes, it's go ahead and do project. That's one. Initial cost may be incurred. Number 2, let's say you are wanting to put up an apartment in somewhere. So purchase a land. So you try to start some initial work. You're getting some advances from prospective buyers. Then you start something. Maybe initially ground clearance and all that, land preparation, and then you start piling, right? So what happens is halfway through you can't say, no, I am not getting enough orders, getting money from people. Then I may not be in a position to continue this, so I need to drop this project. But now initial cost that you incur on piling and all that is maybe big compared to total project. Now when you are going to give up this project, you need to recover whatever you have incurred. May not be easy because since piling and everything has been started, somebody who is interested to start the project, to start the similar project only, come and have a discussion with you. They are only willing to come and invest on it. Otherwise, nobody would come because it's not now a bare land. So initial cost is something that you have already incurred, could be some cost. So difficult to bail it out. If you are going out of the project, sometimes you lose the money you have invested. Maybe next man in may not be interested to purchase at the price that you are going to quote, because he might think about, I have my own plans. Probably I might have to, change the piling and do it right from the beginning. So means that the initial investment that you have incurred, maybe part of the project, or maybe before the project, could be a big amount and difficult to bail it out. Then third one, close relationship with shareholders. Because now when you talk about the bigger projects, so you need to make the investors, shareholders involved in this project, because it's a wealth maximization of the company, not just a profit. Now, let's say if you purchase something and sell it over a margin, we talk about you earn some profit. It's not a long-term oriented investment. But you purchase a land to estate to factory to and go to the next level means it's a big amount or survival strategy related issue of the company, and then that will have an impact on a wealth of the company. So when you take the wealth of the company, obviously shareholders will have an interest idea. Okay, so these are the nature of investment, importance of investment propositions. You need to know. Sometimes examiner would ask us, what do you understand by the project financing? Why the project financing is important? What's the nature, the features of the investment decision? What are the importance of investment decision to a company? Like that, there may be general questions he could ask. For the last two questions that you can answer using these two areas, that nature and the importance. The first two questions, so now we are going to answer through the definition of the project financing concept. Any questions up to now? You can ask questions, anything that you are not comfortable. Any question? All clear? Okay. Then we move on. I know it's not difficult, but only thing is you need to make sure those things are very much closer to your studies, and then we never know at which level those questions could be put on or test for us. To that extent, Those things are important, right? Okay. Then we try to understand about the project financing. It's again very important concepts. So the definition is basically tells it's a long-term financing of infrastructure and industrial projects based upon the projected cash flows rather than the balance sheet of the project sponsors. Very good, important point has been mentioned there. What is that? That is based upon the projected cash flows than the balance sheet. Now, generally, if you say purchase maybe joining land, right? If you're running up, say, supermarket or a bit of bigger shop, and then let's say if you want to purchase a adjoining land, what I'm going to do is probably you might purchase it using maybe part of loan, part of cash, right? And then next thing is basically you are trying to settle over a time, maybe 2 year, 3 year, 4 year. But there you don't need to be very much worried. Why? Because the existing P&L and balance sheet has the adequate strength. Existing cash flows may be sufficient to repay that particular debt because it's not a bigger debt for you. Maybe 10 million is basically that you are thinking about. And then you are in a position to service it without a difficulty. But suppose you are trying to put another investment like maybe a supermarket, which is basically similar to whatever right now we are doing. And for that to succeed, you need to do a lot of work. The amount involved is maybe not a 10 million now. It could be land, building, stock, maybe working capital, and then you think about marketing, advertising, hiring new people, right? New terms of trade with, the buyers and suppliers, right? So basically, it's like a bigger investment. Now, success of the particular supermarket is now depend on the cash flows that you are going to generate in future. That's the difference between the projected cash flows, the cash flows generated in the future versus the balance sheet of the project sponsor. Now, early example, because you are very much comfortable because right now we are generating adequate turnover, profits, cash flows, having a good network. You can depend on the sponsor can pay it without any problem, right? But the recent example, latter example, to having another new supermarket similar to whatever you are doing is not a simple one, because you can't expect the promoter to pay the debts that you have taken on behalf of the new venture. Existing balance sheet P&L does not support for the future investment repayment. So that's a main feature that you can note it down for the project finance. Basically, repayment is based on future cash flows, projected cash flows, not the balance sheet of the sponsor. One. Then, number of equity investors known as sponsors, syndication of banks, which they provide loans, because given these infrastructure projects are bigger and complicated, maybe a single sponsor cannot start it all because it may need a bigger investment depending on the project that I am talking about. Hence, there may be multiple of investors, equity investors we call them sponsors. Similarly, there may be multiple banks, maybe 1 or 2 or 3, a kind of a syndication can get together and do the lending, which we call the loan component. If you take, say, harbor project, highway project, maybe coal power plant, those are bigger projects. There will be one particular person come and do those investments because it's big, huge, complicated in terms of operation, so cash flow management, to marketing, to so many aspects that you need to look into. Then multiple of bank with the multiple of investors and go together and do this project. That's another feature that you can find it out in terms of projects. Not all, but some. Then third, non-recourse loans are secured by the project assets, paid entirely from the project cash flows, which is the point number 1. Then creditworthiness of the project sponsors, a decision in part supported by the financial modeling. So basically, it talks about the security of the project. Now, generally, when you give a loan to a company, right? Loan to a company, you expect to take a collateral. So that is most probably land, building, machinery, vehicle, whatever the assets under the particular businessman. But in terms of project financing, it basically tells to us you need to have the project assets as collateral. Let's say you are going to purchase a land, put up a building, and open up a supermarket. Means your security is not a separate land. It could be the land, it could be the building, it could be the machinery that you are going to install, furniture fittings, maybe the stocks, personal guarantees of the company directors, or maybe contracts to some extent. Like maybe the supplier contracts that you are having could be to you. Buyer contracts could be assigned to you, because there may be some buyers who purchase in a bulk and they pay in like 30 days, 45 days, like that. So you might have those contracts also to be part of your collateral, because the buyers directly pay the promoter's account, which is operated in your bank, because you have a better cash flow control. Because why we try to do everything? Because it's risky, it's complicated. You can't allow the promoter to run it and pay my dues. You can't do that because it's a new, starting from the zero. The money, bank, sponsor, both are invested, both have committed. So both have responsibility to run the project efficiently, effectively, pay off your debts while making a profit to the sponsor. That's what the fourth point is telling. Secured all of the project costs, including revenue producing contracts, like buyer agreements, sales agreement, could be under your control, because you need to ensure that the particular sponsor through the project selling these things, getting this money, the timing, cash flows, amounts, and how to deduct your repayments, and everything has to be looked into. The last one, project lenders are given a lien on all of these assets and are able to assume control of a project if the project company has difficulties complying with the loan terms. So very good point, the last one. Let's say now you as a financing partner provided a credit facility to put up this, maybe one of those project initiatives. Then halfway through now you see the promoters are not in a position to pay off debts as expected, or the promoters are not in a position to implement the project as expected. So then what we try to do is, we may have to take over the project. We may have to take over the ownership. We may have to appoint some of non-executive directors representing bank to oversee the project operations and get this running, get this operating, and then pay off your debts accordingly, because it's important. It's a big amount you're talking about. Right? If the company is not doing well, means not only the company, but also the bank also now could be in a difficulty to get this service. So those are the features of project financing that we need to know. Sometimes the examiner would ask us, write a short note on project financing. What do you understand by the project financing? What do you think the features of the project financing, right? Or maybe these are maybe 1, 2, 3, 4 and the features. So you need to underline project financing features. So those are the questions that one can see in terms of examination. So need to be ready. So which is very important slide. Again, I'm telling for exam. Right. Any questions up to now? So we have discussed very important 2 slides which are directly relevant to exam. Any questions? Nothing? All clear?
What's the meaning of financial modeling?
Yeah, sorry, I couldn't tell you. Financial modeling is like this, Chandi. Like, let's say, since these are more futuristic cash flows, right? So we need to use some models like sensitivity analysis, scenario analysis, or maybe some kind of financial modeling into Excel related applications, or like the tools that we are going to discuss here about NPV, IRR kind of thing. So those are the financial modeling that we are trying to discuss here. Because now, generally, these repayments are futuristic. We can't expect everything happen to be very much normal, because there may be so many things could come and change the shape of the refinancing plan. Then we try to do is we try to model the cash flow payments which could happen in the future with different variables including into it. Now, just to example, in case of say financial forecasting or sensitivity analysis, what we are trying to do here is we have some models inbuilt and developed by different institutions and people. Say we have identified some key variables, say price, maybe volume, maybe cost, maybe interest rates. So we try to change one at a time in time to come. Let's say you give a loan to 15-year plan to a customer, and then we can't expect the interest rates to be right now for the next 15 years also. What if the interest rates are going to be changed by 100 basis point, 200 basis point, 300 basis point as a worst case scenario? And then what could be our profitability? What could be our cash flow? What could be our interest cost? Then whether the client is in a position to service the particular debt in year 5, year 10, year 50, like an example. Or there may be multivariable, not only interest plus cost, maybe tax, some couple of variables going to change. Then we try to do a scenario analysis, another financial modeling tool that we are talking about. We try to change couple of variables at the same time, and then we see what is my turnover, what is my profitability, what is my cash flows, and what kind of the ratios that, remember we did some ratio analysis later, and then we try to use those ratios in a projected scenario, in futuristic scenario, and then see whether that they are in a position to service the debt or not. Let's say yes, sorry, if they have no problem even after issues, we are happy. What if they are in problematic situation? In case whenever using the sensitivity, stress testing, scenario, there may be crystal ball is another model that developed by Excel to understand the futuristic operations of the particular variables. So many models there. So let's say the outcome of these one or two models is unfavorable. Then what could be our solution? What I'm going to do right now then? Because Chandi asked that question, so I just wanted to take another point or two to justify the situation. Because if in a worst case the client can service, we are fine. If it is not, what our plan should be, then we try to develop alternatives, which is right now we are thinking, let's say there may be a chance that the client is unable to export the quantity as originally planned for these countries. Hence that if you think there may be impact on the particular countries, let's say EU example, European Union, UK, so there may be a chance that they might reject, they might reduce our orders because we have that experience. Future also could happen. Then we need to develop our plan B, alternative markets. You can't do it at when they reject it in future. It's good that you start it today. Maybe 80% to EU markets, 20% to East Asia, Japan, China, Korea. So you need to develop right now. So by the time there may be issues that you might have increased to 20% to 30, 40, 50, because their varieties, species and things have been different to the European markets. But you need different, the processing inputs. Just taking about, say, some tea or about fishing industry example, then you know for sure that if there is some impact on European market, you can't service your debt. As alternative, right now you have a segregation of your markets, not everything to EU. Maybe by 5th year, 10th year, you need to have at least you grow your non-European market from 0% to 30% to 40%. That is the initial condition that you may propose as approval condition for this credit facility. Why? Because we found out, based on the previous experience and the present climate, we expect something bad could happen in the future. That is not only the financial inputs, non-financial inputs also. Remember, we were doing non-financial tools under Pestle. We expect not today, tomorrow, future. It's like ongoing activity. If we think some impact on future using the Pestle model, those parameters will be included here to depict our financial numbers. And then we take some count actions in terms of financially and non-financially to manage the project in future scenarios. That's the base of the financial modeling, which tells you how well the company can repay the debts or not. If it is a difficulty, you need to take early actions to manage those difficulties, because we never know what could happen in the future, because you can't sometimes model everything. But at least good that if you have covered some possible expected outcomes. Is it clear, Chandi?
Yes, sir.
Okay. Any other questions? Very good questions for Chandi, because it's like, I think everybody got benefited. Actually, I missed it, the financial modeling, though that I'm planning doing those things right now, but it's better I could have explained earlier. But thank you, so since you have taken it up, so I was able to give some briefing on that. Any other questions? Samindri, Shashika, Udita, Raveen, Akilan, Rachini, any questions? Any further clarifications? It's all well. So can we proceed then? Okay, so thanks, Samindri. Hope same with others. So let's start on the more important areas in terms of investment appraisal. So there are 4 methods of investment appraisal we are talking here. We're talking about payback, accounting rate of return, net present value, internal rate of return. First we take very briefly, and then with the example we try to get this further internalized with the more clarity. Payback period. It's like, let's say you have some 10 million rupees today, and some of your friends have approached you, and they ask whether I can invest that 10 million into different investment propositions they are having. One can say that you can invest a land, and so we develop it and sell it and get the money back. Other would say we have a land and we put up a apartment, maybe for middle class income earners, and then we realize the money. Or you may invest in a stock market on fundamentally strong shares, and we can get a dividend income, and we can get the capital gain after 5-6 years based on the trend. So like that, there may be a couple of investment plans in front of you. Now what you need to do is, you need to use the payback period, and then based on the payback period, you try to take a decision. So based on the payback period, if you are taking a decision, then it is like this. It is to recover your initial capital. When you are going to recover the initial capital, you are not worrying about anything else. You put 10 million today, and after 3 years, one project proposition investment plan give the money, another give 4 years, another give 5 years, another give 6 years, right? So you can get the money back. Capital we are going to invest, say during the period also, not only initial, maybe secondly also, that you need to put some capital, for example. So total capital is going to recover in 2, 3, 4, 5. So the payback period is that. Right? So how soon you can get the invested money in a project is the payback. Lesser the period, you prefer. Why? Because you put the money, you get the money in 2 years. So you are happy. Higher the tenor, higher the repayment, higher the periods, you have a risky, because there may be some other factors also could come here. So in the payback period, you are not worrying anything else, only the time taken to recover the capital investment. That's a payback period. Number 2, so we will do a illustration bit later, but here we'll try to understand what is the particular tool and the definition, because in exam situations, we may be required to give a kind of a brief description as a MCQ or section B part of the question. Okay. Then accounting rate of return. Accounting rate of return is something where return measurement in a profit. Payback is totally about a cash flow. You invested some money, you get the money in terms of cash flow. ARR is the P&L related, profitability as the investment. Say you invest 10 million and average profit, let's say 3-year, 4-year, 5-year, 6-year project, say something, and then divide the profit by investment, you get a figure. That's called ARR. Higher the ARR, you say, I'm good with that. So similar projects we have discussed just a little while before. Let's say gives the ARR of 20, 25, 30, 35. So 35, you say is higher return. That's to profit to investment. So I'm happy with that. That's what we told ARR. The method, the computation method, so now we'll be discussing little while. That's number 2. Number 3, that's the present value of the net cash flows, less the initial investment. That is something a bit complex as well as more practical, because these projects are future oriented, spans a longer period of time. Then we think about the time value. If you remember at the initial point, I was telling you the value of the money could differ from day 1 to day 365. Value is different. What you can do today, you can't do it in 365 days. So similarly, we apply that principle here. We try to discount, we try to apply the net present value concept into the cash flows you generate, say year 1, year 2, year 3, year 4, year 5, like that. And then you see the difference between initial cash flow and the future cash flows is a positive or negative. For example, in the same examples, I have 10 million. I invest in today. So 10 million going out as cash outflow. No time value, because time value is 1 because it adds today. But when I invested that 10 million in the project, so year 1 I am get 2 million, year 3 I am get 3 million, year 4 I am get something 4, 5, like that. But now I am in a NPV. What I have done here is, irrespective of the time value, I see how much I am getting year 1, year 2, year 3, year 4, collective, and then difference is initially 10 million. When I am get that 10 million recovered, and then that time we say payback. NPV, I am not taking that 2 million as it is. We say after 1 year you incur 2 million. That 2 million I bring it to today. Maybe value is 1.9, not the 2 million. I was telling you, because in after 2 years, after 1 year you have 2 million, means you can't do the work you do at today 2 million, right? It could be 1.9, 1.95, for example. Then year 3, year 2 you have 3 million, but when you bring that into year 1, today value, it's maybe 2.8. So like that, so all cash flows occurring in future, you try to bring it to today using a concept called discounting, which I'm going to learn in detail. And then you see what is the difference between initial value and the future values. Future value discounted today. Then everything is today. But some going out, some coming in. The difference is negative, means we are not happy with the project because we invested, what we return is a negative figure. That's not good. We invested, what we are getting, and the difference is positive, then we are happy. So that's the concept of NPV. Last one, IRR, internal rate of return. That again, similar like ARR, but here we try to arrive a rate, and that rate will take into account to time value of money, right? That rate is taking into account the time value of money. And then we say, what's the rate? If it is beyond our expectation, we are happy. That's what the IRR. Say, I am investing 10 million. I want 10% return. That's my investment proposition. And then is project 1, 2, 3, 4, 5. So maybe 3 projects gives me less than 10. 1 project gives me more than 10. So I am saying IRR is more than 10. I am happy with this project. But the main difference between the ARR versus IRR, ARR is profit to investment, but here again cash flows, but we take the time value into equation in computing IRR. Okay, so basically we are trying to understand 4 tools today, that is payback, ARR, NPV, IRR. Now what we are going to do is, we'll take one example and using the example data to compute each of these tools and more familiarization to be done. So any questions up to now? Any questions? Nothing? It's all clear? Any questions?
So sorry, I couldn't follow ARR.
Right. ARR is basically, now suppose you have a couple of projects. Each projects give you a profitability, say X, Y, Z, Q. And for all the projects you have initial investments of maybe 10 million each. What we are trying to do is, so we take average profit of project A divided by initial investment plus maybe whatever, if you have a final investment. So let's say average investment to average profit, project A. Go to the project B, average profit to average investment. Project C, average profit to average investment. Project D, average profit to average investment. We compute that. And after the computation, we say a higher ARR, we will accept that project because average profit to average investment is higher, which is the highest. So then I am happy to accept that. Where you are dealing with profits and investment in the ARR. Is it clear now?
Yes, sir. Thank
Right.
you.
So we go into very detail about the particular question, then you get the further understanding. Any other questions on the concepts? Concepts are clear. Okay. Let's move on. So this is the example if we are trying to understand 2 projects. So we, as a company, we need to choose one of them. Initial investment data has been given. And then we are supposed to compute payback, ARR, NPV, IRR. And we need to give our recommendations. So that's what basically our task is today. Right. So if you go to the data for the 2 projects, right? You can also, I think, if you don't have the presentation downloaded, you can write it down in your notebook, because when you go to the next page, you might miss this. That is project A, project B. Then initial investment, year 1, project A we have 45,000, year 2 40,000, year 3 35,000, year 4 30,000. Project B 100,000 initial investment, year 1 30, year 2 30, year 3 44, year 4 46,000. Then they speak of depreciation charge for the each year is 20,000, because for this project they may have been using some machinery, and for that they have given depreciation charge also. In addition, at the end of the project successful life, there may be residual value of project items, which is 20,000. So means at the end of year 4, we will get back another 20,000 cash inflow into the project. Right. So now we are required to compute, say, starting from payback period. Right. Hope you have written this down. Project A, B, initial investment 100, year 1, year 2, year 3, 4, 45, 40, 35, 30, 30, 30, 44, 46, depreciation 20 per each year, residual value 20,000 for both projects. Right. First, get this down, take so that it's easy for us to move, because this needs for all the computation. Okay, right. So then what we are trying to do here is right. This is what we need to do. I'll show you part of that and then we can start. Now we are supposed to compute the payback period. What is the payback period? Payback period is the time taken to recover the capital that you have invested. Or in more technical perspective, it says the point in time at which cash flows turn from negative to positive. So when the cash flows is converting, turning from negative to positive, that point is my payback period. So how can you do that is, you say project A, you have year 0, year 1, year 2, year 3, year 4, put it into row form, and then the next column you can write the cash flows. Year 0, what happened is 100,000 going into the project, negative 100,000. Year 1, 2, 3, 4, now you have written down some cash flows. So column 2 will be those cash flows. Then go to the cumulative cash flow column. Year 0 is minus 100,000. Now year 1, how much? 100,000 plus, how much we are getting? Anybody can suggest, because you have the numbers.
45,000.
45. So then 100,000 plus 45 is, then the cumulative cash flow is minus 50?
55,000.
55,000. Go to the year 2. See the cash flows and then add to that the cumulative cash flows. Like that. So prepare the first table. First column is year 0, 1, 2, 3, 4. Cash flows, you just say 100,000, 40,000, 45,000, like that. Then you need to compute the cumulative cash flows and see what you are getting. See whether you are getting, for the year 1 you get minus 55. Year 2 you are getting minus 15. Year 3 you are getting 35,000. Year 4 you are getting 50,000 and the cumulative cash flow is 70,000. See, everybody is getting this. Anything you missed it?
So year 4 cash flow is 30,000, isn't it?
Right. Why it is 50 here? Anybody can suggest?
With the residual value?
Question it
That's
is
right. Yes.
30,000.
Yeah, because the residual value is whether it's a cash inflow or outflow.
Inflow.
Inflow. So that's why the 30,000 plus 20,000 come in here for year for 50,000. Because any project, there may be some machinery or vehicle or whatever leftovers. You can sell it at a price. That could be inflow to a company cash flow. So that's why 30,000 be added by another 20,000. So comes to 50,000.
So that means residual value. If there is a residual value, we need to add up in the last inflow.
Last year. That's right. Last year you need to add that because it mentions that both projects we have a residual value of 20,000 each. Right. I think that is clear, right? Anything on the residual value? Okay. What if the company introduce some cash flows in between? What could be the impact? Let's say year 3, a company introduce another 20,000 towards the business, towards the project. How do you include it here? Then what could be the year 3 cash flow? Plus 35,000 and minus how much?
20,000.
20,000. Then the net cash flow actually it should be only 15,000 here. Okay. So basically what we are trying to do here is we try to use each year cash flows included here, and then going to the last column, we try to see what is the cumulative cash flow. So negative, 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 positive, positive. Then what is our payback period now? Udita, any question from you end? Okay. What is the then payback period? That is the point where cash flows turning from negative to positive. So where you find that point? It is in year 2 or year 3?
Year 3.
Year 3. If you can, straight away, you can say 3 years is the payback period. But it's not good because it's good that because there are 2 projects to compare, we need to see that after 2 years, how many months, how many time required to reach the payback. In order to do that, what we can do, because we have 15,000 here, that 15,000 is in this 35,000. Am I correct? Because this 15,000 needs to be recovered on this year 3 35,000 cash flow. If the exact fraction is 15,000 divided by 35,000. Are you in agreement with me? 15,000 divided by 35,000 is the fraction that you need beyond 2 years. Is everybody in agreement with my comment? Any gray area there?
I couldn't follow, sir. Can you please explain?
Now, we agree the payback period is not the second year. Why? By end of second year, we have minus 15,000 to recover. By end of year 3, we know for sure that we have reached the payback. Why? We have positive 20,000. Then this 15,000 is within the cash flows of year 3. Okay. So that 15,000 should be within this 35,000. Right? Because at the end of the year, we need to recover 15,000. And when come to the year 3, we have a positive cash flow of 35,000. That 15,000 is within the 35,000. Am I clear now?
Yes, sir. Yes.
So then the fraction could be 15 divided by 35. 2 years plus 15,000 divided by 35,000 is total time taken to recover my 100,000 capital to something. Is it clear for others how we arrive the payback? Then what's a number, Padmendra or Chandi? 15 divided by 35 is something.
0.42.
Right, 2.4, right? Then 0.4. So the payback for project A is 2.4 years. Is it fine, everybody? 2.4. කාට හරි එක තේරෙන්නේ නැද්ද? රවි? අකිලන්?
No, sir. Can you brief it again?
Right. So you get the 2 years is clear? Because at the time of year 2, you need to recover 15,000. Is it clear to that point?
Yeah.
Fine. Then how much we need to recover in year 3?
15,000.
15,000. So where that the 15,000 to be recovered from which?
35,000 out
Right.
of 35,000.
Year 3 cash flows is 35. So then what's the payback definition? Is the point in time at which cash flows turn from negative to positive. So it means that minus 15,000 is at the end of year 2. Then somewhere down the year 3, that 15,000 will come to 0. That is the point we call payback. So in order to recover that 15,000, we have money left. That is year 3 cash flow, 35,000. Then exactly 15 divided by 35 is exact point that we are interested in. That is we call 4%, 0.4. 15,000 divided by 35. So then at end of year 2, you have 15,000 left, and 2.4 years, even we are covered that 15,000 from the year 3 cash flows. Then technically payback period is 2.4 years. Is it clear, Ravi, now? How the 0.4 comes?
Yes, sir.
Right. What about the others? Rachini, Padmendra, Akilan, Samindri, are you all clear?
Yes, sir. Thank you.
So,
Okay.
so can we take that 0.4 as 4 months
Not 4 months. Then how much? 0.4
divided
into
by 10 into 12?
12, that's right. 0.4 into 12, then it's months. That's something for 48, something 12 into 4 is 0.48, exactly 5, right? So in that case, 0.4 into 12 is like 5 months. Because 4.48, no? 4.8. 12 into 0.4. That's a 5 months. Then 2 years and 5 months. You can take it that way. Okay, Padmendra. 0.4,
Yes, clear, sir.
if you want to convert it to months, that you have to multiply by 12. That's 0.4 into 12 is 4.8. Means 5 months. 2 years and 5 months is the correct answer there. Or either you can say 2.4 years. That's also correct. Right? So then, can we, everybody attempt the project B? Take the same route. Yes, Samindri. Either way correct. 2.4 years or 2 years and 5 months. Samindri, you can use both versions. Both are correct. Either years or you can say years and months. Right. Can we take a effort on project B? So take 5 minutes among you and use the same data, project A, as column 1, year 0, year 1, year 2, year 3, 4, cash flows with project B, and then cumulated cash flow. So have this table for project B and let me know the answer. Take 5 minutes among you. Similarly, you can take year 0, year 1, year 2, year 3, year 4 as the first column, and then cash flows minus 100,000 for the year 0, and year 1, year 2, year 3, year 4. Remember there is a residual value for the project B also. Then go to the cumulative cash flow table, year 0, year 1, year 2, year 3, year 4, like that. And then see what could be the answer. Rachini, Udita, 2.9 years. What about others? $2.9, 2 years and 11 months. Anybody having some issues in arriving that 2.9 or 2.2 years and 11 months? Who has not got that?
Can you please explain it to me again?
Right. So we wait for the others. And how much have you got, Taruka?
So I have got the answer as 54,000 at the year in 4 years. But there's an issue of taking that 9%.
Okay, 0.9, right?
Yes, sir.
Okay, we'll see.
Okay.
What about others? Ravi? Akhilan, Padmendra?
I'm okay, sir.
Okay,
I'm also okay, sir.
right, fine, thank you. Akhilan? Rachini? I think. Okay, great. Yeah, oh, sorry, Rachini and Ravin, you have already responded. I missed it. So let's see what's the answer and how it is arrived, right? Right. Here, first we check this. Now, see whether who has missed these numbers. Taruka checked what is wrong with your computation. Year 0, cash flows 100,000. Year 1, we have 30. Year 2, we have 30. Year 3, we have 44. Year 4, we have 66. See whether have you got that numbers first?
Yes, correct.
Correct. Then you have 100,000 minus 70,000 minus 40,000 plus 4 and the 70,000 for year 4. Have you got that also correct?
Yes, sir.
Fine. Then what we are trying to understand here is, now if you go to this year 2 end, you have still 40,000 to recover up to the payback point. The payback is basically it has to from negative to positive. So end of year 3 you have 4,000 positive. So it is in between these two. This 40 has to be within this 44. Is that clear?
Yes.
Right. So then what is the fraction we are talking about? 40 divided by 44. Because this 40,000 to be recovered within this 44,000 in year 3. So 40 divided by 44 is the fraction that you are interested in. That comes to 0.9. By end of year 2, you are yet to recover minus 40,000. That is been within the year 3. Minus 40 divided by 44, which gives that 0.9. That is how we got the 2.9.
Thank you, sir.
Okay. Now go back to the computation. That's how they have done here. A, 15,000, 35,000 is that we are interested in, 0.43 exactly. 2 plus 0.3 is 2.43 is the answer for project A. Period B, 40 is within this 44,000, that is 0.91. It's 2.91. So as Samindri mentioned, you can have this years or you can have 2 plus 5 months, 2 plus 11 months. Then based on A and B, what do you suggest as a best project? Project A or project B?
Project A.
Okay.
Project A. Why? Because the shorter the time
Recover.
taken to recover the capital. So the payback, basically the decision anyway lies, later also we will learn it, shorter the time, shorter the payback, prefer with the decision, because we earlier also mentioned longer period there may be a different risk could emanating. Hence shorter payback we will take our decision based on that answer. So answer is project A when comparing A and B. Hope everybody is fine with that. Okay.
So, excuse me.
Yeah.
So, this says 2.43 years.
Hari. What's the issue?
And so, we have to calculate months, right?
No. You can have either years or you can have years plus months. No difference. Like if you say 2.43 years, it's a acceptable answer. If you want to convert that 0.43 into number of months, like Padmendra suggested, that you can do 12 months into 0.43, which gives you some 5 months. When you go to the second one, 0.91 is the fraction which is in years. 0.91 into 12 months gives you 11 months as the number of months. 2 years and 11 months. 2 years and 5 months. Either way, it's acceptable. Is it clear? Tell me that if you are not clear, let me know. Again, I can explain.
No, sir.
Is it clear or not?
No, sir.
No. So what exactly you are not clear?
So, how if we say 2.91 years?
Okay.
So, the 91 means 0.91 means the fraction.
Fraction 2.91, because here we are producing the answer only from years. 2.91 years. If somebody want to convert this into, say, years and months, how we can do that? Roughly, if you want to convert this totally into...
So, if it is a period, we have to say it in years and months, right? Or days?
No, that you can say it's years and months. That's a one way of mentioning that. And also, you can say 2.91 years also, that's an acceptable answer. I mean, like, now, let's say you have meters, centimeters like that. So you can mention it in meters, no? Something by decimal. But otherwise, you can say, my height is 5 meters and 3 centimeters or 10 centimeters, right? Either you can say 5 meters is maybe, say 3 meters plus 10 or something like, so 300 so centimeters, 100 centimeters is 1 meter. So you can say all in centimeters. All in meters also you can mention, or you can say meters and centimeters. You getting my point? Like say
Okay.
weight, you can say kilogram and gram, 3 kilograms and 200 grams, or you can say 3200 grams, or you can say 3.2 kilograms. Either way, I mean, it's not very much make a problem for you, but better if you are putting it, the first one is years and months, second one also years and months, so then it's comparably it's easy. If not, you say years. But in most frequently what we see is, we are not very much interested in going into computation this fraction. We say just 3 years, 4 years, like that. But here, because it's like very much closer, so we can't say the payback is 2 years and 3 years. But if you go by these years, project A, the payback is 2, right? 2.43. So if you see that it's more close to 2 years, and then payback B is 3 years. Either way, it's A is good. But good that if you go to nitty-gritties and compute and say exactly this is 2.43, 2.91, then it's easy to compare. That's what we have done here. Hope it's clear now, right?
Yes.
Okay. Let's move to the next one. That is ARR. This is a computation steps, right? You can make a small difference here. Now, first step is annual profit. Annual profit is not only net cash flow, you say annual cash flow minus depreciation. That is easy. Then otherwise it may not be exactly clear. So first you need to understand where you get the profit. Year 1, year 2, year 3, year 4. You are making some profit. That is the cash flows that they are talking about. And then there is a depreciation for each year. So for every 4 years, every year you can compute annual profit. What is annual profit? Annual cash flow minus depreciation. Year 1, year 2, year 3, year 4. Then you can compute average profit. That is total profits divided by number of years. 1, 2, 3, 4. Because those 4 years only we are making profit. Third, investment average. Initial cost, residual value divided by 2. Because initially there is an investment, that's about 100,000. And finally also there you have some investment leave out, maybe 40,000 or whatever, as you mentioned, 20,000 average investment. Then you know average profit, you have average investment, dividing each other, you get the ARR. I think steps, there are 1, 2, 3, and 4. See whether you can apply that into project A and project B and come up with answers. So you can have 5 minutes from now on. See whether that you can do that steps, each step. Go to the year 1, year 2, year 3, and year 4. And see whether what is the profit. How you are going to compute the profit? Yearly cash flow minus the depreciation. Yearly cash flow minus the depreciation. So for the 4 years, you will have now annual profits. Stage 2, you can compute the average profit. Step 3, initially you have 100,000. End of the year 4, you have some residual value. Add up those two, divide by 2, you have some average investment. Then step 4, average profit to average investment will give you a ARR. See whether you can get that answer. If anything, please let me know. Go by one and see whether you can get that answer. You can use the original question table data for this computation. Any issue? Yes, let me know. Has everybody done the year one profit? Can anybody suggest what is the year one profit? Say project A. Who has computed the year one profit? Praveen? Padmendra? What is the year one profit? Can anybody come up with the answer just to see whether that you have in the right path? Who has done
the minus figure, no, sir.
Rachini, you get the minus figure. Why? What is the year one cash flow?
Do we have to take the cumulative figure or the?
That's what I got
No.
the cumulative thing.
We have to get year on year.
Only the main cash flow, sir.
Yes,
I got
year
the
one we have a
cumulative.
cash flow. What is the cash flow?
Okay, sir. Okay. Then I got the cumulative thing.
No, you have to, because
Yeah.
year 0 you can't get, year 4 residual value you can't get. Those are not cash flows. Say what is year one cash flow minus depreciation. Samindri come up with 25,000. What about the rest? You can continue computing Samindri for the rest of the years. Project A. What have you got? Chandi, Taruka, Akilan, Padbendra, what are your year one profits?
It's 25,000, sir.
Fine.
25,000 and average profit also 25,000.
Okay.
25,000, sir.
Okay. Then continue year 1, year 2, year 3, year 4. You have annual profit each, then average profit divided by 4. Please check whether you are getting that average profit. Annual profit 30,000. Not sure, Samindri, because you can't take the residual value there. Residual value will be taken only for the step 3. First, see what is the cash flow. I think 46,000 or something, and divide by 20,000, right? Not exactly sure. What's the profit? What's the cash flow for year 4? $30,000. So then 30,000 minus 20 is 10,000 is the profit for year 4 profit. Because residual value has come up in this computation as the step 3. No, yes. Residual value will not be taken for the step 2. Step 1 and 2. It's coming for step 3. Has everybody computed the profits for the year 1, 2, 3, and 4 now? Any issue in computing profits? what is the total profit now then? And what's average profit? Who has got that? Rachini, yeah, 70,000 divided by 4 will be something 18,000, yeah, 17,500 is the average profit. Is everybody getting that? Average profit. Step 2.
So what's average profit? Is it 42,500?
No, 17,500. The total profits is 70,000 divided by 4. What is the last year profit you have got? It should be 10,000.
10,000, yeah.
Right. First year is like 25,000.
Yeah, second year 20,000.
Now 45. Third year,
15,000.
right? 60 plus 10, 70, right? Total profit is 70 now. 25.
So
20.
don't we get average profit?
Yeah, average profit is equal to total profit divided by number of years. Total profit is now 70, right? 25, 20, 15 and 10.
I took it as 1 by 1.
Right.
25,000 divided by 1 and 20,000 divided by 2. Not that way.
No, it's not like that. So that's like number of years also 4. Then total. If you go to the step 2, that is total profit divided by number of years. Number of years is 4. Total profits is 1, year 1, year 2, year 3, year 4. 70 divided by 4. 17,500. Then step 3.
Excuse me, sir.
Yeah.
So last year cash flow is 50,000.
No, because with that residual value, no.
Yeah.
Residual value has not taken here as the profit
Cash
calculation.
Include,
It's
yeah.
in step 3 because it's initial and initial investment and the residual value taken as the average investment in this equation.
All right.
That is step 3.
Okay.
You have
That's
to take
clear.
that into step 3. 100,000 plus 20 divided by 2.
Okay, sir.
That is 60,000 is the step 3 answer. Has everybody got that? What about the step 3 answer?
So is it 40,000?
What's the initial cost? Rachini, you can compute the step 4 ARR.
100,000.
Right. And the residual value?
20,000.
Right. Then
80,000 divided by
100
sorry,
plus
it's
20
4, right?
divided by 2. Yes. 60.
So excuse.
Yeah.
Average capital invested means I need to divide it among 4 years. The
Average profit now we have already computed under step 2.
No, sir.
That is, yeah.
Average capital invested. Yes, sir. We have.
That's 2, no? Because there are 2 inputs. One at the start and the last one at the end. Divided by 2.
So is it 29%?
Right, correct. Is everybody getting the 29%?
Yes, sir.
Right. So this is the answer. See whether you're getting it. 25 year 1, year 2, year 3, year 4. That divide by 4. Step 2 17,500. Average invested 100,000 is the initial capital and 20 is the residual 60,000. 17,500 divided by 60 will be the answer is 29% will be the ARR for project A. Hope it's clear. Right. What you could do is you can do project B at home and see what exactly you are getting the ARR for project B, and then compare project A and project B ARR. Higher the ARR, you need to accept. Right? Compute and see what could be the answer. So we'll discuss it in next week in detail with the rest of the investment tools. Just to recap what we have done today. So we completed the investment financial statement and ratio analysis by looking at the usage of financial ratios and 3 methods of memorizing tools in ratio computations. Right. Then we move to investment tools and analysis, where we started discussing about the importance and the nature of the investment tools, and straight away we move to understanding the investment tools. So we have discussed two, that is payback period and ARR. We have familiarized those two concepts with some illustrated examples, and next week so we'll continue with the ARR and two important tools, that is NPV and IRR. So thank you for joining and stay safe and great week ahead. So we'll meet next week as scheduled at 8 o'clock next Sunday. Thank you.